Okay, we are going to get started. If you don't see the screen with the one big beautiful bill, or you can't hear me okay, you can either raise your virtual hand or put something in the chat and one of us can see you. You can also always use the react buttons like Marissa did. There's a little thumbs up. You will remain muted until the end of it. So if you're trying to talk to us at all, we won't hear you for that purpose. All right, let me give it one more minute here. There are copies of the slides. Marissa's putting them into the chat. And I believe they were sent out in the last email at around 3 o'clock or so as well. So you will have those. Okay, we're going to go ahead and get started. Hello, everybody. So everyone thinks that the tax code is very complicated. It's not really if you don't try and read the board when the guy is squiggling the numbers on there. You have us to help you decipher it. So today we're going over the tax changes from the One Big Beautiful Bill Act, the OBBBA Act. I'm Angela Ledwidge, if you don't know me, strategic tax advisor and enrolled agent at You Tax. As I said, everyone's muted. It's going to be about 35 minutes, probably closer to 30. And then we'll have Q&A, at which time I can take you off mute. And we can also use the chat to put questions in. So feel free to use that if you have questions that you need answered beforehand. This is general education. It's not personalized tax advice. We'll have time for personal one-on-one sessions later. And at the end, we'll have details on that. Be sure if you're unmuted or in the chat, you do not share your social security number, date of birth, full address, names, information like that. Instead, speak generally, use general terms such as my husband and I have social security, or I'm a single filer. I wanted to start out with some of the headlines that are out there. We don't want you to believe everything that you read, everything that you see. A lot of them are clickbaits. So we have obviously the direct deposit for the $4,900. You're not going to get $4,900 in a stimulus. You're not going to get $1,700 in a stimulus. These were written on the 27th and 28th. There's another one that's going around about a $2,000 stimulus, a $5,000 stimulus, and the latest one, the tariff rebates. That one I know is in Congress, but we don't have any updated information. So until it's signed by the president, nothing is fact, nothing is true, and you don't want to believe it. This one I got on my phone on July 5th, the day after the bill was signed, and it basically says Social Security tax break. The senior deduction is not a Social Security tax break. So we'll go over that in a few minutes, but I just wanted to share some of the fake news that's out there. They are typically written so that you click on the content, and when you click on the content, they get paid for it. How many times have you been on Facebook or some other news article and you accidentally clicked on the advertisement? The people that posted it got paid. So even if you don't buy anything, they still get paid. So those are what most of those are out there for. We don't want you to use those. We want you to come to us for professional guidance. We usually know your tax bracket. We understand your situation, and we can plan in scenario based. So we can say, okay, this and that. Your barber knows the clipper blades and your haircut. Your butcher knows the cuts of meat you like, and I know your taxes. And so we ask that you use professionals into the industry that they are in. Don't compare yourself to your neighbors or ask how you can be like Mike. The better question is to ask how you can optimize your own situation. We have the beautiful bill that got signed on July 4th, the Patriotic Day, which was intentional by him. And so it has permanent TCJA extensions, new deductions for seniors, the tips, the overtimes, the enhanced SALT, business tax improvements, and critical deadlines. This matters because most everything starts in 2025, which means we need to start planning now for it. It's going to affect this year. And you have 5 months to still figure out what this is and to plan for it. Immediate action for some of these needs to be taken. We'll go over that in a second. And it's basically a strategic planning window for the next 4 to 5 years. So we want you to learn how this actually impacts your personal tax situation, not just know there's a $6,000 senior credit, right? We want you to understand it. So what is it? It's the largest tax relief since the Tax Cut and Jobs Act since 2017. It's a $4.46 trillion tax cut over the next 10 years. Not that you're going to get $1 of that, or, well, you might get $1, but not that you're going to get to see all of that, but you will get benefit from it depending on your tax return. The next is, again, it was signed on July 4th. It introduces new tax reliefs and affects every tax category. So if you have kids, if you own a house, if you're a senior, you buy a car, if you have electric vehicles, all of those things are impacted on your tax returns now by this bill. Again, it allows for tax planning opportunities for the next 4 or 5 years. One of the things it did is it made permanent tax rates come into play, the enhanced standard deduction. It does a 20% QBI deduction for businesses, and the 100% bonus depreciation is now permanent. Some of the new tax benefits that I know you've heard of in the news are senior tax deduction, tax-free tips, overtime, enhanced SALT, which is state and local tax deduction, and car loan interest. And of course, there's some other ones like the child tax credit and the Trump accounts. The critical deadlines for most of these, the first one that comes up is the EV credit. You have until September 30th to get the car delivered to you, and then it's gone. If you don't get it done by the 30th in your hand, it is a gone credit. The next one is the solar install. It must be installed by December 31st. That's a 30% credit still, but it has to be installed by the 31st. The rest of the stuff begins in 2025. The Trump accounts, worker benefits, and SALT relief have deadlines that they will expire by. And so we'll talk about those. So the solar credit, as I mentioned, is expiring September 30th. This is kind of a big one. Not all of the cars will qualify for it. It's a $7,500 credit. And of that credit, it can also be a partial credit, $3,750. Of that credit, you have 2 options. You can get the credit on your tax return or through your dealer. So we want to make sure that we look at that because some people don't qualify for it at the dealer and some people do. It is a non-refundable credit. It reduces your tax, but it will not create a refund for you. You may see a refund, but it does not create the refund. There's some limits based on car requirements and vehicle prices as well. One of the next things that's important to know is this also has an adjusted gross income limit. And the reason I bring this up is if you buy a car in January or February, you will have the $7,500 credit, let's say that, or rebate credit that you got at the dealer. And let's say you have a $100,000 a year job. In the middle of the year, you get a raise, change jobs. You now have $175,000 as a single person. You will be required to pay back that $7,500 credit. So it's really important to know that. And if you happen to have bought a car in the beginning of the year that your income changed dramatically, then you probably should reach out so we can address that because we can do some planning for it. The permanent extension of the tax brackets, previously in 2017 under TCJA, they were in the 15 to 35 or 39.6 brackets. They're going to maintain the current brackets we're in for the past few years, and these are now permanent. So this is your tax brackets. I get asked a lot how tax brackets work. So I wanted to go over that. We have here a sample of the tax rates. So 10% to the 37%. 10% is 0 to 11,600. Many people look at this and say, okay, I make 75,000, so I must be in a 22% bracket. That is right. Your marginal tax rate is 22%. But when you actually look at how the tax bracket is broken down, 11,600 is taxed at 10,000. Then everything from 11,601 to 47,150 is taxed at 12%, and so forth and so forth. So the easiest way to think of it is if you're in the 10% right now, and let's say you go to 50,000, so you're in between, you have overfilled your bucket and the spigot is pouring out into the next bucket. So it's not necessarily you're taxed everything at 24% or everything at 22%. It is a bucket overflow effect for your taxes. So senior tax relief, I know this is a big one for everybody. It's available 2025 through 2028, so it does start this year. It's important that we look at this and plan for it because it could allow opportunities for you to take advantage of additional IRA money distributions that you wouldn't have to pay tax on. Or it could slightly reduce your taxes and maybe you need to change your withholding. Since this goes through 2028, it will be something we can plan for now and at tax time and going forward. It does not reduce Social Security, but it will reduce the taxable portion of your Social Security. So if you make enough and you get your Social Security tax because you have a pension, it's going to help you. The eligibility requirements are age 65. It is available to all statuses, but if you are married, you must file jointly. And there's quite a few of the new rules that have that in place that you must file jointly if you're married. Otherwise, you don't get the credits, you don't get the benefits. And we'll point that out in each one. There is income phases for this. So if you are single and make more than $75,000, your credit starts reducing at a 6% phase out rate. So again, if you're making over 75,000 as a single, we may want to do a planning session that's going to allow us to figure out, do you qualify for it at all? So there's nothing like thinking, you've got that coupon for a good deal at the grocery store and you go in there and it's expired. It's kind of the same. If you go over your brackets and your phase out and you thought you qualified, it can really hurt later on. So how it works is it's an above the line deduction, meaning you usually have your wages, interest, and then you get down to your adjusted gross income. So it's going to reduce your adjusted gross income to your taxable, and you get $6,000 for single, $12,000 for married. It works if you itemize or if you do standard deduction. It doesn't matter which one. So you basically get the standard deduction if you're single of $15,750, plus you get $6,000. That's a total of $21,750. So you get more than you originally would have gotten. There used to be, and there still is, the additional standard deduction when you're over 65, which is $2,000 per person or $1,600 per person if you're married. You get that on top of the senior deduction. So in this scenario, if you're single, you'll have the standard deduction of $15,750. You'll have the $6,000, the $2,000, which is the additional standard deduction, which is a total of $23,750. So you can see how that brings it up quite a bit for married individuals from a $31,500 for normal standard deduction, and now you're a senior or a senior couple and the difference it makes. So again, planning, that could release a lot of withholding for you each month. So it makes a big difference. We will have more examples at the end where we kind of show some examples and we can talk through some scenarios. Again, we want to keep them generic. The next thing I have on here is the tips become tax-free. Not all tips are going to become tax-free. There is certain limits on it. certain people that qualify, and certain reporting requirements. So we have the tips. Most of the people that you tip or that receive tips qualify. They have to have it reported on their W-2s for this to work. And I wanted to mention here that if you work in an industry that you receive tips, if you earn more than $400 in any type of income, legal or non, you are required to report it. So I want to make that clear that if you receive cash tips and you never reported them to your employer, you do not qualify for tax-free tips. You cannot go and take it off your W-2 and say, well, I made $500 here, let me take it off here. It does not work that way. So I want to make sure that's very clear. This is another one that you must file joint. So you have to, if you're married, you got to file joint to get this one. It's still subject to Social Security Medicare taxes like it is now. When you get reported tip income on a W-2, it's still reported that way. There are income phase outs as well. And it's 25,000 is the maximum deduction. So I know I have a client that in the state he lives in, he basically works for tips. The hourly wage is so small. So he will only get a max of a $25,000 deduction, not the other way around. The next one we have is the overtime tax relief. And this is an interesting one because a lot of people thought that their overtime also would be fully tax-free. Of course, that's not how it works. The way this is going to work is it will have to be documented by the employer. So I'm assuming they're going to have something that's going to report on a W-2 for us. So they're probably going to change the form. It's a max of $12,500 for a single person and $25,000 for married. It also has income phase out. So if you make over $150,000 as a single person, you don't get to take off overtime deductions. Again, married must file jointly in order to get the credit at all, or the deduction, sorry, at all. It is limited to the time and a half. So when you look at overtime pay, and I'm actually going to show it on the next screen, it's only limited to that half part of the pay, not the 1.5. It's only 0.5. So there's guidance that's still coming on this as well. We don't have all of the how's it going to be reported? How exactly do we report it to our employer? We don't have that yet. So you'll have to give us time. Most of the IRS stuff will come out probably late December, January for guidance. So some of the items, while we know the numbers and we know where it's going to be in a section on the return, we won't necessarily have how it's going to be reported to us. So we can do planning, we just can't exactly answer where it's going to be. So an example of how this works is Maria earns $20 an hour. She works 250 hours of overtime at time and a half. That sounds like me. Her regular rate is 20 hours. Her overtime pay is the $10 an hour because overtime in California is time and a half. So it would be the 20 plus the 10, which is the half, right? So that's why they did it this way. It's basically only that extra $10 on top of her 20. So it's only that 0.5. And that's basically a savings about $550 for her. And the next one we have is the SALT deductions. This is a big, big one this year. And what this does is for 2025, so this year it starts. This is one of the amazing planning ones we can do. It starts for 2025. And it's a $40,000 max. Now, of course, the government's going to give you restrictions. That's just how life is. So the new SALT limits are $40,000 for 2025. Each year it'll increase by 1%. So next year it'll be $40,400. Your income needs to be below $500,000. And it's modified adjusted gross income. So Maggie is modified adjusted gross income, which can mean different things for different levels. Social Security modified is different than the SALT limit modifieds. Basically, I'll take some things out, like it might take like state taxes paid if you're doing the modified for the state taxes. So it depends on what we're looking for. There are no gradual phase outs. So again, if you hit that 500,000 as a married couple, you get back to the 10,000. You don't get to stagger down like most of the deductions are. Married filing separate thresholds, I want to point this out here, is 250,000. So it'll go up a little bit next year. California is a community property state. So if you live together, you basically have to take all of your income and expenses and split them in half. That's the rules. It did say married filing separate could benefit some couples, but again, you're in California, it's going to be different. If you're in a non-community property state, then we can talk about it and look that over in a planning session. So again, 500,000 or 250,000 for married filing separate, you stay at 10,000. I want to make sure that's clear because it's a big issue for a lot of people. So at 25,000, let's assume you get 25,000 more of SALT deductions, which is in your Schedule A itemized deductions. It is state and local taxes, real estate taxes, DMV fees paid, other property taxes. That area has been limited to $10,000 in the past. So that is what is increasing to the 40,000, which is then increasing your itemized deductions potentially by 30,000. It's a huge saving. So if we jump up 25,000 in your itemized deductions and you're in a 24% bracket, that's a $6,000 savings. That one's a big one. This is probably the best benefit there is out there. And being in California, we're very thankful it's here. We have some business improvements that came through the 20% QBI. We have 100% bonus depreciation came back, which is amazing because basically when you buy a piece of equipment, you can depreciate it upfront 100% instead of over the life of it. The enhanced 179, I believe it goes up to 400,000 now. So that's a big improvement as well if somebody's buying a piece of equipment for their office. And then there's a couple of other different things, expanded eligibility. The 1099 threshold, that one is, oops, go back, sorry. That one's a big deal. Typically you had to have, if you paid somebody over $600, you issued a 1099 to them, it's now going to be a $2,000 threshold, and that starts in 2026. So that is not a 25 thing. 2026. So businesses won't have to send out, well, they're not required to. They still should, but they don't have to send the 1099 to people. So that's a big one too. The enhanced child tax credit raised from $2,000 per child to $2,200 per child, and this will stay permanent. So this will last for a few years for sure until a new president comes in and possibly changes it again. That's what we mean by permanent, just so you're aware. The credit amounts, they will be indexed for inflation. The refundable portion is $1,400 per child. And then you must have the valid Social Security numbers for both parents, and it has to be issued before the return due date. Married couples, at least one spouse must have the valid Social Security number. So you could have somebody that has an I-10 or they're a non-resident coming in to the United States. The Trump account for the young savers, this is another big one that's coming up. This one, children born in 2025. So January of 2025 through December 31st of 28. Those children starting in 2026, I believe it's a year from it, and that's why it says July. They get $1,000 from the government to fund an account. They can invest in whatever they want. It has to be used for education, first-time home buyer. They can start up a business with it. They can put it into an IRA account. Anybody can contribute to it. So grandparents, government entities, charities, everybody can do it. It is, so it's $1,000 government into it, and then it's $5,000 a year that anybody else can put into it for that child. You can contribute until age 18. Once you hit 18, it'll have to be moved out to a different account. And like I said, or used for one of those purposes. Distributions cannot be taken from it until the age of 18. So if you're looking at a way to make sure that your child or your grandchild or your niece or nephew or whoever is saving money for when they get older versus they realize they have money and then spend it on a gaming system or something, this would be one way to do it. And because it's a prohibited way for them to touch the money, for it to grow. So that's not all. There's many other items that have come up into this bill. Most of them are new deductions, like the car loan. PMI is coming back. We used to be able to deduct that. And then enhanced dependent care. The car loan interest, I believe a long time ago we used to be able to take it. I want to say in the 80s. The car loan interest will be available for 2025 through 2028. It's up to $10,000 annually above the line, and it's going to have income phase outs. This one, as far as I can tell, it's going to be on the front page of the 1040 is where it's going to be reported. I assume it's going to be kind of like now when you have your mortgage interest statement. I think it's going to be based off of a statement, not necessarily a form. So we'll have to wait and see. They may require the car places to do a form like your mortgage 1098. So it does say, again, it's available in 25. We're not going to have the guidance until December or January. So when we send out our letters of these are the items we need, we may not have that on there yet and may have to ask. So if you happen to see it ahead of time, find out. If we find out before we send those letters out, we'll make sure we let you know. The other one I want to point out is the enhanced dependent care benefits. It will now be from $5,000 to $7,500 is what your employer funding one can do, your dependent care benefits. So definitely look into that. If you're not contributing to that, that is better than taking the child care deduction on your tax return. So always take advantage of your employer benefits first. The dependent cares, the FSAs, the HSAs. HSAs are a big one too that are tax savings. If you have those items at work and you haven't taken advantage, that would be a great time to reach out to us to do a session for tax planning to make sure that we can look into that. The PMI deduction, that one will come back. That's helpful if you are paying the private mortgage insurance premiums because of a lower down payment or interest rates. It also helps for the VA funding fee. That also comes in there when you do a refinance under there. Not the interest rate reduction ones, but a real refinance where you have to pay the VA funding fee. They say simplified gambling loss reporting, and I'm not sure why it was worded that way either, because it is gambling losses. You were able to take them 100% of your actual winnings. So if you won 5,000, but you only lost 1,000, you can take off 1,000. It's only up to your winnings. Now it's going to be 90% of that. So now you'll get to take 900. So I'm not sure on that. And then again, the 1099s for the $2,000 is there. We were talking about the SALT, the state and local income tax on the itemized deductions. This is a real life, real world SALT optimization scenario. So we got Fred and Wilma. They're in their 50s. Fred makes $254,000 and Wilma made $146,000. We had married filing separate for Fred, and Wilma files head of household. She has a child in college. So they have a unique situation where they are married, but they do not live together. So he is able to claim married filing separate. She's able to claim head of household. From there, we look at it for their itemized deductions. And one of the things we knew was they each had, about 20,000, 15,000 in state and local taxes and real estate taxes and all that. Well, they're both limited. So under 2024 rules from the TCJA, they get capped at 10,000. So For Fred, because he's married filing separate, he's capped at 5,000. Wilma gets 10,000 of her 15. So it's a waste. Nobody liked that rule when they had it. I hated that rule because everybody has a lot of state taxes paid. So the Fred scenario, when we look at the first half, again, no benefit because he was limited to 5,000. Wilma, on the other hand, she at least is going to get a $2,000 bonus from the new limits, from being able to go from her 15,000 in expenses to the new SALT limit of 40,000. So that's fantastic. But what if we were able to reduce Fred's adjusted gross income so he's no longer over the limit? This is a tax planning strategy that is, you can do it. So he's only $4,000 over that limit. So when we consider what would take him under 4,000 of income, one of the things we can do is we increased his 401k contributions for the rest of the year to get that extra 4,000 in there. He wasn't maxed out. Obviously, if you're maxed out, that's not going to be a plan, and we need to look at our other solutions that we can come up with. So we increased his 401k contribution. So you can see here a sample. Since we now got him under 250,000, we used the new SALT allowed increased. You'll notice the red 20,000. Again, he's married filing separate, so it's 20,000, not 40,000. Previous years, it was 5,000, not 10,000. From that, it lowers his taxable income for a refund of $13,000. So it took his taxes from $52,000 to $39,000. That's a huge savings that most people wouldn't even realize was there. So if we change his withholding and reduce his withholding, it puts more into his paycheck that then allows him to put more into his 401k without taking any money out of his pocket. So Fred was happy. So that strategic move basically gave him an increased refund of $13,000. He's going to fund $16,000 more into his retirement account. And like I said, basically no money out of pocket. Wilma will still get the $2,000. So that was a win-win. But it is one of those scenarios that I think we need to have the strategic planning session on. So if you know that you haven't been able to benefit from the state and local taxes because you've been limited to that 10,000, we should do a plan because it's going to make a big difference. It's going to allow you to change your withholding and put more money in your paycheck. In this case, with 13,000, I mean, for the rest of the year, that's quite a bit of money that you can put into your paychecks or put it into your retirement, pay off the high interest debt. I mean, there's a lot of things you could do with that money. I could think of things if you can't, so you can always share. We have, the strategic plan, unless you have the crystal ball or you know how to do the tricks to get to the end goal of saving money and having more money in your paycheck, which is what we try to do for you. You can't do this on your own if you don't know about it. Most people would look at that and say, oh, I'm over the $250,000 limit, so there's nothing I can do. Instead of looking at it and going, well, what if? What if we just changed a few numbers around in your paycheck? It makes a big difference. So planning is for sure the most helpful thing you can do. As we discussed that, strategic planning is analyzing, developing, planning, executing, and monitoring. So that's why we have those 12-month programs that we do for a lot of clients. It gives you the full year. That's also why we're open all year. If something comes up in the middle of the year, you have a job change or a home sale or buying a home or marriage or kids, we want you to call us. This will allow you to get you in, anytime that it's convenient for you when something's happening. So there's a lot of differences. There's income timing strategies, looking at these new tax laws, deciding on married filing separate or not, and deciding, if you're newly married as married filing separate, when is the optimum time to move in together, right? Because maybe if you're telling me in November you just did that, maybe you wait till January 1st. So at least you get 1 year of a benefit. Multi-year coordination, because these deductions are over multiple years and we have this 4 to 5 month window, year window, we should be able to plan for quite a few things and really make some adjustments. And we definitely have to plan at the end. When all of these changes stop, we need to be looking at it to go, is this something they're going to extend? What does it look like if they don't extend it? So that you're not hit, in the blind side from the law changing again all of a sudden. The immediate actions to take would be the EV credit. If you're doing an EV credit or solar installation or even thought about it, you definitely need to reach out and do a planning session on that, because that's going to be a big saver to make sure you're making the right decision on either one. There's too many salesmen in the pot on that will say, oh, you get a 30% solar credit. And I know a lot of my clients can testify to this. You get a 30% solar credit, only to come find out when you come do your taxes with me, you don't have a taxable income, which means you don't get a credit. Yes, it'll carry over, but if you're on Social Security that's not technically taxable, or you don't have a filing requirement, are you ever going to use that credit? Probably not. So it's important to know those things before you go buy. Feel free to go get quotes from the salesman. Ask them their opinion on it, but then reach out to us and do a planning session to make sure that you actually qualify for it, because that makes a big difference to somebody. The 30% can be anywhere from a couple thousand to tens of thousands. It makes a big difference in your pocket. We also have the new benefits that start in 2025. So car buyers, you want to research things, you want to know how it works. Senior clients, we can do the planning for the deduction, the multi-year income planning, the SALT optimization. Those are long-term because they're over periods of years that we want to make sure we plan for them. So what's the advantage of UHeart Tax and Financial? We have, obviously, some of you have seen this before when I've done my tax plans. We can do the what if scenarios. The newer software I have that I've been using for a couple of years allows me to do multiple scenarios and including the state. Before, I used to not be able to do the state on them. So we can get a lot closer to exacting our numbers when we do our planning sessions for federal and state. And it's a great thing because we can change things like crazy. So, if you're the spouse that doesn't want to work anymore and you want to see what that looks like, we can put it in there. We might put in a good word for you, right? Deadline management reminders, IRS record keeping guidance. We're going to tell you what you need, when you need it, how long to keep it. The IRS compliance, year-round access, proactive strategies, because I want to make sure that we're planning ahead. So when we file the tax returns, that's a compliance. We're just doing the paperwork at the end. We just have to submit that proof of what we did for the year. No big deal. You already know all year long how that's going to result. You're going to know in March, April, what you're going to get for the next year. And there's not going to be any guessing. There's not going to be any scary times, because if you have a change in your life, you would be reaching out to me. And of course, the best part of UHeart Tax and Financial is me. No, I'm just kidding. So based on what we covered today, I do know many of you are going to need the personalized analysis. It's going to make a big difference on your pocketbook every month, every paycheck. Especially if you're fixed income, it's a good idea to look at it, because we may be able to get that couple extra $100 that's going to help now that groceries and everything else is getting more expensive. So we did make some available one-on-one sessions, and we will have a link that you can schedule those for. What you'll get is a 60-minute consultation. You'll get the complete analysis, how it impacts with the OBBBA Act for you in your situation, not generic overview like this was. Multi-year tax projections. So we'll do for a few years on there. If you know you're going to retire in 2 years, we can figure that in and look at it. Written summary and action plans and advanced strategies such as the SALT optimization, how best, like this in this case, right? Using the 401k to lower the income to get it done. So those are the types of things we'll do. Typically our session minimums for tax planning is $350. For the webinar, we were going to do it at $295, but we decided that I would rather you guys come to me and ask me questions about this because it impacts so many different people. So that would be $100 off. So there is a coupon code underneath that link. Marissa put it in the chat. I see it in there. You can use this. It's good through August 1st, which is tomorrow. So I believe you can go through like August 1st all the way to midnight to be able to use it. But I do recommend that you register for it. Though the one-on-one session is going to be one of the best planning sessions we can do for you. It's not going to be the all year planning session. It's going to be let's look at your 24. How does it impact you now? And what can we do to plan for the rest of 25? And then in 26, when we get the tax return done, that's when we would be doing the rest of the planning forward. So I want to make sure that that's clear because I want to be totally open, upfront, clear on everything and the way, our sessions work. But you can see in that one example of Fred and Wilma that I gave, that was a $13 or $13,000 difference. So I'm sure that can make an impact in a lot of people's lives. So that is our presentation. That is our webinar. Thank you for that. We are going to do Q&A. So anybody that is on the live webinar right now, you can raise your virtual hand. I can unmute you. And let me make this screen bigger so I can actually see your names on there. So I know it was a lot of information up front. I know Marissa's been answering some questions in there. I'll pull out and see if there was anything else that needed further clarification on there as well. But this will be our Q&A session. So if you have any questions about generic questions about it, not too specific on yours, obviously I can answer some questions. If you say, hey, I'm 65 and my income range is between 80 and 90,000. Is there a chance I can get it down to do this? If you ask me questions like that, I might be able to give a few solutions, but I can't give exact details to your own particular situation. That's where the planning would come in. Let's see.
That's it for our live webinar. Thank you for joining the One Big Beautiful Act webinar. We hope you found it insightful. As we wrap up this session, we want to remind you of one key aspect. The One Big Beautiful Bill Act has specific implications for your personal tax returns. Understanding how it affects you can feel overwhelming. We offer personalized one-on-one sessions to help you navigate these changes. During these sessions, we focus directly on your situation. Our team is ready to help you make sense of the new tax guidelines. You won't have to go through this alone. We're here for you. Now, what can you expect during a one-on-one session? We'll discuss your unique circumstances. We'll identify how the One Big Beautiful Act impacts your tax return. This tailored approach allows us to offer specific advice, and your questions deserve detailed answers. We're happy to provide them. If you're unsure where to start, think about your current tax situation. Are there areas you're confused about? Perhaps you have questions regarding new deductions. Our goal is to empower you with clear information. To schedule your one-on-one session, please click the link in the description below. We want to support you every step of the way. Remember, we're here to help you navigate your tax returns. Don't hesitate to make an appointment with us. Thank you once again for attending, and we look forward to connecting with you soon.